credit looks wide open. Just how wide open is it right now?
Well, there hasn't been a lot of issuance. We're starting to see a little bit of these frothy deals, and I'll put Netflix in that category.
Yeah.
But issuance hasn't really kept up pace with previous years. And even though we haven't seen a tremendous amount of inflows into the market from retail investors, just the amount of debt that naturally matures and gets called and stuff is leaving a shortage. And until investors start to flee, you're going to see deals like this get done.
Do you think supply scarcity is masking credit risk in high yield at the moment, and to what degree?
I think it's hard to say that it's not. I don't know how big a degree. You have certain issuers where it is, but remember, you're not going to see prices go down until you actually see investors flee the market. Until then, investors aren't going to sell something that they don't think is going to default and they're going to take a loss on.
John, does credit still lead equity? And if it does, what's the message that comes from credit for the equity investor today?
That's a question I have to go back to my old days as a credit analyst at Citigroup, which was a long time ago and well beyond the knowledge of Gershon here. But look, high yield bottomed in June of 2007.
Yeah.
Think about that, where the spreads got the tightest. So it led equities by a good 6 to 9 months, right? Today, does the same dynamic play? I mean, I would think so, right? Most recessions are led by a failure or a lack of access to credit by companies, right? They cut back and then it sort of ripples throughout other sectors. So at some point, high yield will have hit bottom, whether that was at some point earlier this year or next year or maybe the year after, depending on how long the cycle takes. I think equities take a while to catch up to that.
But Gershon, the reason I ask for that is right now, if you look across the fixed income universe, the concern seems to be rates and duration, which essentially is why you see so much demand going into floating rate. I don't see a big concern in credit. I don't see that in high yield, and you certainly don't see it in leverage loans.
So you just used the words high yield and credit interchangeably. And the truth is, this line we put between investment grade and high yield is a completely artificial one, created long ago by rating agencies and insurance companies. Yep. The high yield market actually looks okay from a leverage perspective. The real leverage has been in the triple B market, which we call investment grade, so we think is safer. That's where you've seen the M&A, and that's where you see the intersection of credit and rates. A lot of issuers there have very long papers, 30-year papers. So if there are credit problems there, you're going to see a very large price action and then potentially a lot of supply into the high yield market, not from the new issues of Netflix of the world, but the downgrades, whether it's the autos, maybe we don't want to go there, or some of the other triple Bs.